Hi guys, and welcome to the Lucky Finance channel. Today I'm going to show you how to value a stock and be able to set the right buy price. And the example I'm using is Apple, which is everybody's beloved stock. But what's the right price you should buy it at, and what's a potential target price in 5 years? So I hope you will stay with me as we take you through this process. And certainly I'd appreciate it if you could subscribe to my channel, hit the like button, and also the bell icon so you can continue to get more videos. By the way, I'm Lucky Murugesh, and I'm a Silicon Valley technologist and an inventor. I'm also a pretty avid photographer, global traveler, and a husband and a father. So thank you. Disclaimer, I am not a financial advisor, and everything that you see in this video, all the information is purely for informational purposes. Please do consult your own financial advisor. Investing in stocks is always risky, and you need to fully understand the risks involved. What I hope to provide you today is information that you can use combined with your own information that you can gather to gain knowledge and eventually wisdom. So let's get started. So this is a fairly simple 6-step process. And the steps are written up here. The first one is you need to review the earnings and the dividends for the current year. You need to, let me just mark that there so you see that. The second is you need to review the estimated 5-year growth rate for the earnings as well as the dividends. And that's not always easy to get, but I'll show you where you can try and find that. You need to review the current PE ratio, or the price to earnings ratio, as well as the price to earnings growth ratio, or the PEG ratio. And then we can do a simple calculation to calculate the earnings and dividends over the next 5 years. And finally, we can estimate the future stock price over the next 5 years. I'll also show you some tricks of how you can calculate the right entry price or the target price to buy the stock so as to reduce your future risk. And this technique works really well for companies such as Apple, which have a long history of earnings and dividends. But for some newer companies such as Tesla that do not have a long history of earnings, you need to do something a little different. It's a more fundamental market analysis. And in my next video, I will show you how to do that. So let me take you through each of these steps now in more detail. Is the current earnings and dividends. And here are some websites that you could check out. This particular information I got from seekingalpha.com, but finviz.com is also a great website, and money.msn.com is also a good website. Do be careful with money.msn because I find sometimes they don't update it as regularly, and sometimes the information might be 3 months old or 6 months old. But it's still a good reference as a backup. But I think Seeking Alpha and Finviz are probably the better websites. Now, for our example of Apple, if you look at Seeking Alpha, you'll get a 2020 earnings estimate of about $11.68. And you also have a 2020 dividend estimate of $3.28 a share. So $11.68 in earnings per share and $3.28 in dividends per share. Great. Now that you have that, let's. So in step 2, which is a little more tricky, you got to get the 5-year earnings and dividend growth rate. Now again, Finviz is a great website to check this information. By the way, I don't get paid by any of these guys. I'm just giving you simple, honest information. You can go and get this information for free. For Apple, if you go to Finviz, you'll see the 5-year earnings growth estimate is about 11.47%, which is really good. And the 5-year dividend growth rate is just about 10%, which is also really good. So very solid numbers from a finance perspective. All right, that's the end of step 2. Let's move. In step 3, you got to get the current price to earnings ratio as well as the price to earnings growth, or the PEG ratio. And again, this is where you can use the money.msn site. They have this information. The current PE ratio for Apple is around 15.4. And the current PEG ratio is basically around 1.35. Now, typically, what does the PEG ratio mean? Typically, companies that are high growth have a PEG ratio that's above 1, and it could be as high as 2.0. You will see some companies that don't have enough history that have really high PEG ratios, 4, 5, 6, 8. In general, if you see a PEG ratio above 2, I avoid it because that usually has a lot of risk associated with it. Now, so also on the flip side, you'll see companies that pay a lot of dividends, that have slow growth but high dividends. They have PEG ratios between 0.5 and 1, so between 0.5 and 1. Things like utilities, banks, etc. And that's okay. Typically, I avoid investing in companies that have a PEG ratio below 0.5, since usually that means the market sees some kind of earnings growth risk in those companies. So ideally, between 0.5 and 1 for the slower growing dividend companies, between 1 and 2 for the high growth companies, but avoid above 2 and avoid less than 0.5. Okay. Step 4 is now to calculate the earnings and dividends over the next 5 years. So this is actually a fairly simple calculation. Take out your scientific calculator if you have one. You probably have one on your mobile phone, or you could do this in Microsoft Excel as well. So in case of Apple, the earnings in 5 years is basically you take the current earnings, which is $11.68, and you multiply that by 1 plus the earnings growth rate over the next 5 years, which is 11.47 divided by 100, raised to the power of 5, because we're looking at this over the next 5 years. And if you do that, you get a really nice number, $20, just above $20 in earnings 5 years from now, in 2025. You do the same calculation for the dividends. It's the current dividend, which is $3.28, which we had earlier, multiplied by 1 plus the dividend growth rate over the next 5 years, which is 10.18%, divided by 100, raised to the power of 5. And you get a number of $5.32. So basically, 5 years from now, in 2025, we are estimating that Apple's earnings will be just over $20 a share, and Apple's dividends will be just over $5 a share. Both very solid numbers. Okay, I hope you're with me still. Now to the really important calculator. And I'd like to remind you again, please hit the like button if you like what you see. Please subscribe to the channel and also hit the bell icon. Thank you. So for the 5-year stock estimator, what you do is you take the earnings that you calculated in the previous slide in 5 years. You add the dividends to that, and then you multiply by the average PE ratio and the average PEG ratio. So for Apple, the 5-year stock price would be the $20 that we got in earnings in 2025, the $5.32 in dividends 5 years from now. You add those two numbers, multiply that by the PE ratio of 15.4 and the PEG ratio of 1.35, you get a Apple stock price target of $530 in 2025. Now the current stock price as I'm recording this is around $310. So if you take that number, obviously that's going to change day to day. But if you take that number, if you want to calculate what is the 5-year growth rate you would get if you bought Apple stock at the $310 number, you take the 530 5 years from now, the 310 today, divide that by the 310, multiply 100, and you get 71%. Or if you just average that over 5 years, you divide by 5 and you get a 14% annual return. So basically, if you're buying Apple at $310 today, 5 years from now, Apple will be around $530, which would give you roughly a 14% annual return, which is pretty good. Okay. Now, how do you set the right target price? We talked about how in the earlier step, the 5-year price was at $530, which would give you a 14% annual return. Now, if you wanted to generate, let's say, a 25% annual return over the next 5 years, then a really good buy price for Apple would be, you take the 5-year stock price, you divide that by 1 plus the return that you're expecting, 0.25, which is 25%, multiplied by 5 years. And what you do is you get this number, which comes out to about $235 a share. And that's a good 25%, roughly 25-30% lower than today's price of Apple. But you know what? Apple went all the way down to, I think it was $222 in mid-March during the COVID crisis. So you might get that opportunity again. Now, the other thing is, just to be very safe, you want to try to derate this number by another 20%. So you multiply that number by 0.8 and gives you a price of $1.88. If you got Apple anywhere close to $1.88 a share, that's a screaming buy. That has removed all your risk. just hold on to it. It's going to hit around $530 5 years from now. Now you may not get that price. That could happen just on a really bad day in the economy. But I think the $235 number could happen over the next few months as Wall Street digests the COVID-19 massacre on earnings, and you could hit that number. So anywhere in that range is good. And don't forget, even if you bought it at $310, it's still a pretty good buy because you would still make a 14% return over the next 5 years. I think you all know that there is a current trade war and really a tough situation between the US and China right now that's been exacerbated by the COVID-19 virus. And that could certainly impact Apple sales and earnings. Even though Apple only gets a small amount of its market share in China, I think it's like 5% or something like that, 8%. But still, it is one of its largest growth markets for the future. And if China shuts down Apple, that's going to shut off a potential growth path for Apple. So keep that in mind. Now, over the next year or two, also the biggest thing happening is we are shifting into the 5G telecommunication network. This is much faster than 4G. It's going to enable artificial intelligence. It's going to enable autonomous driving, things like that. Some of the other manufacturers, the competitors of Apple, like Huawei and Samsung, are actually ahead of Apple in this area. In fact, many of their phones already have 5G capability built into those phones, into those chips. Apple could potentially take a year or two to catch up. So there could be a little bit of catch up on Apple if 5G actually goes live in the next year or so. But I'm confident that in 3 to 5 years, Apple will have a pretty high market share even with 5G. Now, the most important thing here is the Apple ecosystem. This is really what drives sales and growth. Most Apple customers are die-hard fans of their products and would never want to move away from Apple because they basically have bought into the ecosystem. So what Apple needs to do is continue to innovate technically on their phones, on their products, but also they need to innovate their ecosystem so that customers can do a lot more just because they're part of that Apple ecosystem. So those are the things you've got to keep an eye on. Okay. To set a 5-year target price for a stock which has had a consistent earnings growth and dividend history. We also learned what the annualized returns could be if you invested at the current stock prices. We also learned how to set a good as well as a great buy target price to reduce your risk even further. And basically, if you invested Apple at the current great buy price of $188, which I'm not sure you're going to get, but it's worth wishing, you could make an annualized return of around 36% over the next 5 years, which is amazing. But even if you invested at $235 a share, which could happen, you could make an annualized return of 25% over the next 5 years. Overall, my recommendation is that Apple really is a core holding in any portfolio. But just wait a little bit. Let the stock market return come down a bit, deflate a bit. It's been going up so much over the last couple of months. I would just wait for the stock market to take maybe a 15-20% correction, which could, I think, easily happen. And you could get a chance at buying Apple again around 235 or even in that range, maybe 250. So be patient and wait for that and hold on to it for the next 5 years. So thank you very much. Again, I'd like to remind you, if you like the video, please hit the like button, please subscribe and hit the bell icon. Thanks very much. Bye-bye.